Good morning, founders. Welcome to another episode of the Gab Lab, a show that is designed to bring you financial information and intelligence that will blow your mind, but it will also build your bottom line. Today's episode champion is Community Futures of Manitoba, with over 16 offices throughout the province to help you build your business and to help you nail your numbers. My name is Tanya Woods Richardson. I am your show host today, and I am joined in the Gab Lab with today's guest, Brian Quinlan. Welcome, Brian.
Great to be here. Thanks for the invite.
Okay. So happy you're here. You're a chartered accountant, correct? Partner of Campbell Lawless in Toronto, Ontario. And Brian, you're going to chat with us today about tax tips and strategies to navigating our 2020 tax return, but specifically how we kind of not take advantage of, but how we incorporate all of the benefits that we received, the COVID benefits in 2020, and how those are going to converge with our return this year. So
sure. Okay.
Thank you. I know there's a lot of founders that are trying to navigate this and maneuver this, so I know that your information will be of great help and insight.
Great. Happy to help out. Okay.
Awesome. So with every episode, as we do, we break down this topic into 3 bite-sized pieces because there's a lot that we're going to cover. Our first part, for all the founders listening out there, our first part, we're actually going to take a look at personal taxes. So even as a business owner, what we need to know when we're taking care of our personal tax return. Our second part, we're going to move into the corporate taxes and some of the benefits that we received for the business. And then the third part, Brian, thank you. You're going to help us to actually be more proactive instead of reactive when it comes to what we need to keep in mind for our 2021 tax return going forward.
Great.
All right. Okay. So let's get started. As we do with every show, we love to talk about the correlation between our topic, such as taxes, and net profit, bottom line results. So I mean, I can state the obvious, which is about the bigger our bottom line, the more tax we spend or the more tax we pay. But I know you have a really unique perspective on this.
Right. What the accountant does is, accountant can't make you money, but accountant can let you keep what you've made. So if you're selling widgets, it's up to you to sell more widgets. If you're investing, it's up to you and your investment advisor to go from a 6% return to a 9% return. The accountant's focus really is how to structure that, whether it be a small business or holding investments. For individual with investments, it would be, should it be in your RRSP? Should it be in your TFSA? Should it be in a spouse's hands or a family trust? And of course, with a corporation business, you want to structure your affairs to take advantage of many income tax incentives that are in the Income Tax Act. Should you have a holding company? Should you have a separate company for holding real estate versus your operation? So it comes down to the accountant in terms of structuring your affairs to take advantage and minimizing the taxes, no matter what your, net profit is that you've made, and the accountant's going to take the tax bill off that. Again, as people say, it's good that you're paying tax because that makes you're making profit. Are you paying as least amount of tax as legally possible would be the question to ask for yourself and your accountant.
Great. Awesome. And I know that you have very specific language that you like to use, and it's about, not taking advantage of loopholes, but
right. They're not. People say the income tax has loopholes for businesses and things like that, and I would say no, it doesn't. It's got incentives in the act. The government wants you to do certain things with your money, so they get a tax break for it. For example, we all can have the TFSA, invest without paying tax. The government wants you to save, so they have the TFSA rules. They want you to fund your own retirement, or so they have the RRSP rules to take advantage of. So yes, you get a deduction and things like that. So, and with businesses, especially the small business, we have the capital gain exemption. The government wants you to go out, start a small business, hire a bunch of people, buy trucks and cars, rent a warehouse. So there's incentives to do that. The capital gain exemption available for a small business owner is a fantastic exemption. Makes people in the U.S. jealous of what we have for small business in terms of income taxes.
Yeah. Well, I want to point out here too, I know a lot of founders, many founders, myself included, we get confused by all the different incentives that are out there. Yes. And, I know that many founders may abdicate some of their financial decisions to bookkeepers or to accountants. But what I find so powerful about your role is that this is your role, right? It's about mitigating taxes, but knowing all of these details up to the founder to ask the questions about where can different opportunities, where do the opportunities exist? Where do the incentives exist? And this is really the whole premise of this show, is to give founders the I don't want to use ammunition, but the tools and the intelligence needed to be able to go ask accountants these questions. I heard Ryan talking about this the other day. What are we doing and how are we using it in our business?
Well, that's interesting, because that's the discussion I don't want to have. I want to be the one that's proactive. So if you have a bookkeeper doing your books, a bookkeeper is a great bookkeeper. A bookkeeper is not designed to restructure your company into holding companies and move real estate out and things like that. So that is the role of an accountant, is to be more proactive. So accountants get excited when a budget comes. We have a federal budget coming in March. There might be some tax planning things that come out of that. So it's our role is in late March to discuss this with all the clients, what they should do to take advantage of the new incentives that are in the budget. So we deal with many entrepreneurs, and they run around with their heads cut off and doing deals, and something we pick up the pieces and we say, well, let's put this piece here and this piece there. So that's really what our role is to not wait for the entrepreneur to ask us the question. We should be more proactive. And if your accountant's not being proactive, why not is the question. So
yeah, thank you for that, Brent. I think that is extremely important for founders to know and understand. The accountant is a part of your team, and all of you are moving that ball forward and getting it to the goal line. All right. So COVID. Yes. So we've got taxes coming up. April is quickly approaching. This is not a regular tax return year. It's going to be like any other that we've ever experienced. Let's switch gears and move to, as a founder, I have a personal life. I've got personal taxes that I'm responsible for.
Yes.
Many entrepreneurs have been able to access different benefit or subsidy programs that our Canadian government put in place for both employees, as an employee of a business, but also as a self-employed individual. So how should we start this conversation? Where do you want to lead us on this? There's a lot to talk about.
Well, let's go with the personal tax return first, because that's all on top of mind for many of us. It's still, we had many extensions last year. Accountants complained tax season never ended. You don't like doing personal tax returns in July and August, but we have no extensions yet. So everything is really due. Your money is due at the end of April still. If you're the big thing there for an individual, if they receive the SERB, the Canadian Emergency Relief Benefit, or the Canadian Recovery Benefit, that is taxable. So that's something new that will go on a tax return, something new to disclose. And I think the government's right now is sending out T4A slips to tell you what SERB or CRB you did receive in calendar 2020. The scary part of that is, it may come as a surprise, the initial SERB, Canadian Emergency Recovery Benefit, did not have any tax withheld. So you may find you actually have a tax bill, and the Canadian Recovery Benefit only had a 10% tax withheld. So you could owe money come April, which is a very tough thing to deal with, especially if your income really was zapped in 2020. So that's kind of a surprise for many people, is that these benefits are taxable. You should get a T4A slip in the mail shortly, and there could be a few dollars of tax owing on that.
So a couple of things there. The SERB, that was actually put in place quite quickly. It's my understanding it closed December 2nd of 2020. And then after that, is that when they moved to the CRB?
Exactly. It's a similar thing. It's designed to be, but they did withhold at least 10% of tax.
Okay,
so
on that one.
People went into the EI system, which withhold tax as well, and you'll get a T4E slip in the mail shortly, kind of thing. And again, that tax, when it combines with all your income, may not be sufficient. So you could have a tax bill on April 30th. So the key there is don't wait for an extension. We may not have an extension this year as we did last year, and you could have a liability. So the least, and you don't want to be late with your tax. There's interest and penalties and things like that. So that's the surprise. It's nice that the government jumped in a year ago, I guess in March last year, to start paying these things out, but it is taxable, and some people have forgotten about that.
Okay, so a couple of questions there. the income that comes in through the SERB, as you mentioned, so this is for the calendar year, it would close off December 31st. You're going to be taxed on that based on the bracket that you would fall into, correct?
All your income goes together on a tax return, and you figure out what your
Okay.
effective tax rate is. And you may find there's a tax bill because the tax hasn't been taken off. We all know when we work, we usually work and your employer takes your tax off. And at the end of the year, without any special credits or deductions, you should break even, not owe not any tax or have a tax refund if the employer's withheld the correct amount. But here, your employer hasn't been involved in everything. So they may have paid you a wage in January and February, pre-COVID. So we don't know what your tax rate is and whether you'll owe money or not.
Right. And I think for many founders that are listening in, if they are, even if they have an incorporation, many haven't listed themselves as an employee. So they're taking a draw or a dividend from the business and then not paying the tax on that. So any of that personal income that you're bringing in, you're going to add your CRB to that, your CERB to that. And then it's my understanding that there's still, it's 13,229 that isn't taxed, and then anything above that with your income, then you start falling into the tax brackets. Is that right?
Exactly. We all have the basic credit, which kind of varies between provinces. So, but generally I would say we all get the first 12,000 or so tax free. So if your income was 12,000 or under, your tax bill is going to work out to zero anyway. But after that, we get into like a 20% tax rate.
And so what about some of the other benefits that we may have received at home, such as the recovery caregiver benefit, you were talking about the CRB, the recovery sickness benefit, that's CRSB. So CRSB, recovery sickness benefit, CRCB, recovery caregiver benefit. The government, it was great. It stepped in with, lots of financial support for us. But does that same law apply where we're going to be taxed on those dollars that came into the house?
You're right. It's exactly the same. So it was paid to you. You'll get a T4A slip. But those newer benefits, those ones you just mentioned, had at least 10% tax withheld. So it's not like the original SERB, which had zero tax withheld. So but they all will be taxable on your 2020 return, right?
One question that I have regarding SERB, for those, I know there was a lot of conversation around self-employed individuals that initially got access to SERB. So they brought it in. Then they found out that they actually weren't eligible for it and that money needs to be repaid in full. And it's my understanding there's a class action lawsuit on that right now, but right now it's still repayable. It has to go back. Is that money that is also taxable, or because it needs to be paid, is there a different application that's applied to that story specifically?
Okay, well that's a good story, and a story everyone is watching, because the government really hasn't. One of those letters that you referred to were sent out to people saying you didn't qualify for the SERB. I don't think anyone's been assessed yet asking for the money back. So the idea is, obviously, if you had to pay money back, you shouldn't pay tax on it. But if it wasn't paid back in 2020, it's not going to be recognized when you get your T4A slip. So it's fully going to be taxed in 2020 because you didn't repay anything in 2020. So the government's really, the whole idea of that is, as any accountant knows, the definition of what income is. And accountants for Tax 101 is, we learn what total income is, which differs from net income, which differs from taxable income. So 3 different definitions of income that accountants live for, but no one else does. And that's how the mix-up started, is what is defined as income. And as you're saying there, for someone applying for SERB, it was net income. So it was your revenue from being self-employment less your expenses. So.
All right. This is why we hire the pros. This is why we hire the pros.
And you start early as well. Start early. You're starting now. It's only February. Nothing is due until April. So we've got lots of time, and the media like this will have lots of articles and seminars and webinars and things like that. So
beautiful. I think that's a really important point, Brian. It's, it's about taking those small but consistent steps, right? Even if people put aside half an hour every day to just continue to look at it and dig it up, it won't feel so overwhelming come March.
And with electronics, it's gotten better in the last few years. Legally now you can receive your T4 by email, which before you had to give permission. So a lot of things, as we're finding pre-COVID now, and even what I'm seeing now, is everything, the banks and the investment advisors are all pretty tech savvy. So you're getting your T5s, you're getting your T4s, you're getting things much quicker than before. So you can plan it. You don't have to go looking in that cupboard in the kitchen where you put your charity receipts and your T4 and things like that. So it is getting a bit easier in terms of technology to be organized. So.
Okay. And it's my understanding too, CRA, you can set up a My Account, right, where everything should be listed there. So you don't necessarily need to wait for it to be sent to you either, right? To take a proactive approach
That's
to
a
it.
great point. Everyone should have a My Account at CRA. Okay. There's a risk there though, because what you're saying is you can see your tax slips, and you're right. Most of your tax slips will be there, but not all of them. Often your T4 is there because everything that's due by the end of February, like your T4 and perhaps your T5 from the banks will be there. If people have mutual funds or some partnerships, those slips come out later in March, and they're not always updated on the website as quickly as you might want them. So it's great that you can go to your CRA My Account, see all your tax slips, but it's not going to be, I wouldn't never guarantee, the government doesn't declare it complete. Okay, and your RSP slips probably won't be there, and your charity donations won't be there, and things like that. But no question, it's very helpful. And if you're doing your own taxes, a lot of tax software lets you download. So you don't even have to key in your T4. You can just download it. So there's no typos or things like that.
Okay.
Okay.
All right. And anything else that we should be double checking when we're looking at these T4s with respect to COVID benefits? Anything we need to watch for specifically other than making sure everything's in there?
Well, something new with the T4, this impacts the employer a bit, is there's 3 extra boxes or 4 extra boxes on a T4 this year at the bottom, where you had to disclose when the employee got that wage. So as opposed to reporting you made $30,000 for the year, you still have to report that in the T4. That's going to be taxed. But there's 4 new boxes that have to break it down into certain periods when the employee was paid. And the periods match up with the CEWS, which we'll probably discuss shortly, is what they're trying to do, or is if to see if the employee was working and getting the SERB at the same time. So there is some extra work on doing the T4s this year, not dramatically extra work, but the government has set it up so they can start double checking for people that might have double dipped. We're still working throughout the year and getting a SERB.
Okay.
So that's something new on a T4 this year. You'll see a few extra boxes, which won't increase or decrease your tax. It just gives the government an idea when you made that money, like what part of the year. So.
Thank you for that. Good insight to know going forward. And so the last piece on personal, I'm just curious about, many self-employed people work from home, and they're probably familiar with all the different, tax incentives that we have working from home and what we can write off. For those entrepreneurs and founders that were new to working from home, are there any incentives or things that we need to be aware of for that new founder where this is a new exercise for them, kind of shifting gears? Anything that they need to know?
Okay, I would say nothing new for COVID. If you work out of your own house, the rules haven't changed at all. You still declare part of you, say you have 1 bedroom, 1/6 of your house is your office. So if that's your main office, then you'll claim 1/6 of the running expenses of your home, including the big ones like property tax and mortgage interest. So the real change there for home office is more, not so much the self-employed person, but the employed person. So if your employer came to you in early March last year and said, no, we're closing up, you got to go home and work at home, you as an employee, because of COVID, you had to work out of your house, you now can write off some of your expenses. And that will be new this year for many employees, the first time they've ever taken a home office expenses against their employment income. Right. So the government's adapted to this. Your employer is to give you a form called the T2200S. It's like the S is for short, so it's simple and short. And what that'll let you do is take a deduction on your personal tax return this year for at least $400. So if you figure out what you spent in terms of the home, it's very simple. If you don't want to calculate it, the government will say if you worked at full-time at home since last mid-March, when we all kind of got shifted home, then there's a $400 deduction for you there. So right away. So without any receipts, any calculations, it's there. If you think you spent more than $400, then you may want to get a full T2200 form from your employer, and you'll write off a bigger expense than $400. So that could be brand new for a lot of employees that were sent home to work from home with COVID, because of COVID.
I imagine so. And so for, for the founders, for the entrepreneurs that are listening in here, even if you are recognized as an employee of the business and that's how you've been paying yourself, this may apply to you in this situation, right? So just putting that hat on as you think about this.
Yes.
3 quick questions in this. Is there a ceiling on what you can write off? You said if your office is 1/6 of your house, or you're actually doing your square foot measurement, but is there a ceiling on that?
Yes and no. How's that for a good accounting answer? So, okay.
Might be a lawyer answer. No, I'm just...
That's right. Not so much to the quantum or the dollar value. It's what expenses you can write off. So a self-employed person is a broader thing. Again, I mentioned you could write off part of your property taxes and part of your mortgage interest if you're self-employed. But if you're employed, you can't. So if you're employed, it really is more utilities and perhaps internet. Perhaps the phone. So a self-employed person is the best way to be in terms of tax write-off. So that's an employee, and this year, maybe the first year they're writing off home office expenses, they're quite restricted. So again, it's not so much the dollar amount, it's what type of expenses. Okay,
makes sense. Thanks for that clarification. Okay. All right, so my takeaways from this, tell me if I'm in line with this. There's no extensions, so start early. This is number 1. Start pulling together all your paperwork.
As of now, I'm leaning we probably will have something, but nothing right now.
Okay, so get started early, schedule it in, set up the My account so you can start to see what's coming in, but don't take it verbatim. Know that there might be additional numbers coming in there. And then just kind of getting a handle too on all of the income that came in, start pulling that together. And if you've worked from home, start measuring square footage and understanding those costs if you feel that the expenses are going to be more than $400. If they're under 400, it's easy peasy.
Yes, exactly. So, and we're in normal tax stuff. It's RSP deadline at the end of February. You should be thinking about that as well. So nothing to do with COVID. We still have the deadlines, and hopefully there is some money there to put into an RSP. We don't want to miss that deadline.
Yes. So thank you for that. I know I do want to touch on that in our 3rd segment moving forward, the distinction between RSPs and TSFAs and what people should be aware of in a year that maybe they haven't made a ton of money, just understanding the difference between the two. Sure. So thank you, Brian. This is going to be a wrap. Brian and I are going to take a brief intermission. I want to thank again Community Futures of Manitoba for championing this episode. We're going to be back for part 2, where Brian's going to walk us through now understanding the COVID benefits that we receive for the business. It's an A to Z, everything in between. So thank you, Brian. We'll see you back here for part 2.